Hello and welcome to week 6, ENT 620. Focus in this video will be C corporations or regular corporations. Very often we'll hear the term C Corp or just regular corporation, and that is what we are going to talk about during this video. So what is a C corporation? It is historically the oldest form of a corporation when we're truly talking about corporate formations, and it is a legally separate entity from the shareholders. So it is a completely separate legal entity, has its own standing in a court of law, for example. This is what we commonly think of when we talk about corporations. Everybody, consciously or unconsciously, they think of a C corporation. For example, Ford Motor Company, Apple, or Tesla would be three of the larger C corporations. The most significant thing you need to know about a C Corp is that it is a separate taxable entity. So everything we've talked about up to this point in this class has been a pass-through taxable entity, meaning for tax purposes, the entity may report earnings, losses, but the profit and loss is ultimately passed down to the owner, who reports profit and loss on their personal tax return and pays tax at their individual tax rate. A C Corp is a separate legal entity, and it pays tax at the entity level. So if it earns a profit in 2023, it will pay tax on that profit. And then when the shareholders receive their share of that profit, they will pay tax on that dividend at their personal income tax rate. So there are two layers of taxation. One layer at the corporate level, and then at the dividend or shareholder level. And so we have two layers or double taxation. What is the corporate tax rate right now? 21% in the United States. Now, that does not include other taxes that may hit them. There's a whole litany of taxes that they could be hit with depending on the type of corporation. There are also many states have a separate corporate tax rate as well that is added to this. But for right now, purpose of this class, we'll just focus on the fact that the entity itself will pay 21% on any gain that it has in a given year. How do you start a C corporation? Just like an LLC, but instead of articles of organization, you file articles of incorporation with your state. And if you click on this in the PDF that I'll upload to the class, this would take you to the Michigan Standard Articles of Incorporation form, which is available free to anyone. Who is in charge of the C Corp? Board of Directors. Board of Directors chosen by the shareholders. They will hire and fire the CEO, all the C-suite leaders, etc. May board members be paid? Absolutely. And in fact, some are paid quite well. It is not typically a volunteer role. Day-to-day life of the corporation, the rules of operation are found in the bylaws. Okay, just like an S Corp. How long can a C corporation or a regular corporation last? Continuous, as long as we want to keep it running. The world's oldest corporation is in fact from the East, and it is a construction company that has been in operation since 578 AD, based out of Japan. C corporation, how many shareholders can we have? It's absolutely unlimited. Ownership is represented by shares of stock, and the owners are called shareholders or stockholders, but absolutely no limit on the number of shareholders or stocks. Who can own stock in a C corporation? You can have LLCs, you can have corporations, and you can have individual people. No limit. Tesla, this will shock you. As of 2022, Tesla had 3.493 billion shares of stock out there in the world that people own. That is significant. And that's a good example of why companies will go public, and I'll talk about that a little bit more later in the video. What about owner liability in the event that the corporation is sued? So if I own 1,000 shares of Tesla stock and Tesla is sued, what is my liability? I'm liable only to the extent that I have shares in the company, meaning my personal assets are protected. But if in a worst case scenario, I could lose my 1,000 shares of stock. But other than that, I'm completely protected. Typically, with a C corporation, unlike an S corporation, a C corporation shares are generally freely sellable, so you can sell all or a portion of your stock whenever you want. What about the deductibility of losses? Where does that take place? Only at the corporate level. So if I'm a shareholder of a C Corp, I do not get to, if Ford Motor Company loses money this year and I do not get a dividend, can I deduct a portion of that loss on my tax return? No. Only the company can deduct that loss. What about the good old self-employment tax? Remember, we talked about that. It's 15.3%. Well, good news, it does not apply in this scenario. It does not apply in the case of C corporations. That's because I'm either going to be a W-2 employee of the company or I'm going to be a shareholder. And in either case, there's no self-employment tax. Dividend taxation. So if I own shares of stock and the company makes a profit and they send me my portion of the profit, that is called a dividend, that is going to be taxed at a rate based on my other income, my tax rate. So it may be as low as 0, as high as 20%, but that's the max. So no matter how large my dividend is, the max I will pay is 20. But again, if the company's already paid 21% and I pay 20, that's 41% before we even start talking about state tax. These very attractive rates here. What I want you to know is that those favorable rates only apply if we've held that stock for 60 days, okay? It's got to be a qualified dividend. So I'm not going to read this to you, but it gives you walks you through an example of what is a qualified dividend to make sure that you get. What about if I buy and sell stock rather quickly? Then it would be a non-qualified dividend and it would be taxed at my rate. Okay, so if I'm in a 27% tax bracket and I've held that stock for a short period of time and I sell it, it's going to be non-qualified and I will pay tax at 27%. Two types of public corporations. First, we have a private corporation and a public corporation. Best example I can give you is Tesla Inc. Why did Elon Musk make Tesla a public company? He wanted huge amounts of cash to, research and develop new technology like, driverless vehicles, etc. And so he could go to the bank and borrow that money and pay interest on that money, which is a liability on the books of the company. Or he could authorize more shares of stock, put those for sale in the public market, the New York Stock Exchange, and get huge infusion of cash that way. When you do that, when you become a public company, first you have to be approved. Not everyone can do it. You have to be approved by the Securities Exchange Commission, SEC, and then you become under the ongoing regulatory review and control of the SEC. So every year you have to make regulatory filings, you have to be audited. It's not easy to maintain SEC status, but again, for those companies that are willing to go through that process, it can be very advantageous. The downside is that you can lose control of the company easily because there are so many shares of stock out there in the market. If you lose majority control, whoever ends up with majority control can get in or place create a new board of directors and essentially fire you as CEO of your own company. Now, you don't lose your shares of stock, but the majority shareholder will effectively control the board of directors. If you want to maintain more control of the company, you keep it private and you avoid all of the SEC regulatory constraints. Thank you very much.